Most people know to use dollar cost averaging when they're buying a stock, but less known is when to sell a stock. At least that was before this video, so tune in. There are simple strategies that you can use to determine when to sell. Here are 3 of the most important ones. By the way, if you'd like me to teach you how to invest, check out the link in the bio. The first method is to take out your initial investment once a set profit is achieved. This method works as follows. The investor sets a target profit. Once they reach this profit, they pull out their initial investment and let the rest of their profits ride. For example, let's say I bought $50 of Dogecoin for 5 cents per token. I think Dogecoin can reach 75 cents per token. However, I don't want to risk holding on to my position from 5 cents all the way to 75 cents. I want to take some risk off the table in case my projection doesn't turn out to be right. So I wait until Dogecoin doubles and is trading for 10 cents per token. Then I take out my initial investment and I leave the profits invested. This way, whatever happens, I've at least covered my initial investment. Dogecoin to the moon? Great. Dogecoin to the back of the barn and shot? Sad, but at least my principal is out. Now, mind you don't have to wait until your initial investment doubles, as was the case in our example. You can set your investment pullout to trigger at 20%, 30%, 50%, or whatever number floats your boat. The important thing is that once you reach this target percentage, you take out your initial investment. I think this method is most appropriate with things like crypto, where you may be convinced there is a non-zero probability of an enormous upside, but also the possibility of a reversal, as we recently saw, and losing your initial investment is quite material as well. In such cases, recovering your initial investment after a solid run in the asset's price and only keeping the profits in play can be an extremely wise thing to do. The second method to use is target weights and rebalancing bands. Portfolio target weights are the desired allocation or proportion of each investment in a portfolio. For example, an investor may want to allocate 50% of their portfolio to Tesla, 30% to Johnson & Johnson, and 20% to Cisco. These proportions make up the target weights for the portfolio. Rebalancing bands are the range within which a portfolio allocation can deviate from its target weights before it needs to be rebalanced. For example, if the target weight for Tesla is 50%, the rebalancing band could be set at plus or minus 5%, meaning that if the weight of Tesla in the portfolio deviates from 50% by more than 5%, the portfolio needs to be rebalanced by selling the overweight positions and buying the underweight one. Rebalancing helps keep the portfolio aligned with the investor's desired allocations and risk tolerances. So what does this mean in practice? Let's say you have a $100 portfolio that is invested based on the target weights we mentioned. Therefore, you have $50 in Tesla, 30 in Johnson & Johnson, and 20 in Cisco. Let's say Tesla's price rises faster than Johnson & Johnson. The weight of Tesla in your portfolio reaches 55% and the weight of Johnson & Johnson falls to 25%. In this case, since you're at that limit of plus 5% on Tesla, you sell the excess weight in that position and you use the proceeds to buy the underweight position, which is Johnson & Johnson, to bring it back to its target weight. One of the challenges of this method is that when you are rebalancing and selling for a profit, you're likely creating a tax event, meaning you have to pay taxes on your profits. So you don't want to rebalance too often, and that means you don't want to make your rebalancing bands too narrow. Also, when you're doing this, you're not really accounting at all for the fundamentals of the asset. Maybe one position is rising faster for a really good reason, and the other companies in your portfolio have deteriorating fundamentals. Why sell winners in order to buy losers? Why cut the flowers and water the weeds, so to speak? This method works best when the assets being rebalanced are all high quality, their fundamentals aren't deteriorating, but they're appreciating on different timetables, in which case this method can be a great way for moving money out of the hot asset into the cooler one in anticipation of the latter heating up while the former cools down. The third method is the valuation method, and this is the method that basically says you sell when the price of the company exceeds what you think it's actually worth. Pretty logical. This is the primary method we use at PIF when building our portfolios. Basically, we compare what the company is trading for today and what we think it's worth based on discounting its future cash flows to present-day dollars. To learn how to do this from yours truly, check out the link in the bio. In my assessment, this method will yield the best results, but it requires the most effort. This is because to apply it, you have to have a solid understanding of the company and an ability to forecast its future cash flows based on this understanding. After calculating a company's worth, if the price of the company ever exceeds your estimate of what the company is worth, you sell. So to summarize, when to sell, you can either set a target profit. Once achieved, pull out all or part of your initial investment. 2, set a target weight, and then when deviation from these targets reaches a certain limit, you sell. And then 3rd, sell when the price of the company exceeds what you think that company is actually worth. Hope you found it useful. If you did, subscribe. Until next time, Assalamu alaikum and peace be upon you all.